All right, everyone, welcome back for another deep dive with me. And as always, I've got an expert here with me. And today we're going to be talking about something that can be a little stressful. I mean, let's be
Mhm.
real, watching your investments drop never feels good. But we're actually diving into an article today that says these market downturns, uh, you know, corrections, while stressful, they can actually be opportunities.
Yeah, absolutely.
So this is an investment strategy piece. It's originally in French, but don't worry, we're going to break it all down for you. And it basically says that these market corrections, they're not only predictable, but they can actually be a chance to build some serious wealth. So get ready for that.
Yeah. You know what's really fascinating about this article is how much it emphasizes that, market corrections are historically predictable. Like they happen pretty regularly every 2 to 3 years on average.
Yeah,
So this one, after the last one in 2022, shouldn't really come as a huge surprise to anyone.
yeah, that's a good point. Yeah. I remember 2022, it was definitely a little bit of a nail biter, even if, kind of what to expect.
Yeah.
It doesn't really make it, any less anxiety inducing when you see those numbers going down.
No, not at all. I mean, think about it this way. The source highlights a really powerful statistic. If you miss just the 10 best days in the market over a 19-year period, that can actually cut your potential gains in half.
Wow.
Imagine your $10,000 investment growing to 64,000, but if you miss those key days, it's only 32,000.
Oof.
And a lot of times when people panic, sell during a dip, they end up missing out on those critical rebounds.
Yeah, that's a really sobering thought. Definitely makes you want to think twice about, hitting that sell button when things start looking a little scary. But I gotta say, this correction, it feels a little different, than others that I've seen. It's actually driving this downturn specifically.
Yeah, that's a great question. And the source points to kind of this perfect storm of different factors, creating this uncertainty that we're seeing right now.
Yeah.
Okay. So, economically, we've got this persistent inflation. The consumer price index is up like 4.3% year over year, which is leading to a lot of speculation about, more interest rate hikes. And then on top of that, you've got the political landscape, with the upcoming elections. That always adds volatility.
Right.
And then to make matters even worse, you've got this lack of transparency in some recent corporate acquisitions, and that's spooked investors. So all of these factors combined are really making people hesitate.
Okay, so it's not just one big thing. It's just like a bunch of little things all hitting at once.
Exactly.
Yeah. But, I'm looking at this, and it seems like the author is actually pretty optimistic about this being a buying opportunity.
They actually acknowledge that there could be further drops, even as much as 5 to 10%.
Okay.
But their argument is that historically these corrections are actually excellent times to buy into strong companies at a discount.
Okay.
The key they emphasize is focusing on companies with solid fundamentals and growth potential.
That makes sense. And I actually thought it was really fascinating how the source used Nvidia as an example. I know, obviously, this isn't financial advice or anything,
Right, of course not.
but I think it really illustrates the point perfectly.
Yeah, absolutely. So Nvidia's stock price, it's dropped significantly from like $130 down to 105,
Right.
but the company itself is still really strong.
Yeah.
Their chips are super vital for AI development, and that's a sector that's just expected to grow exponentially.
Totally.
So this dip could actually be a great opportunity for long-term investors to get in at a lower price.
Absolutely. And that's where, looking at things like price to earnings ratios and those future earnings projections, that's where it becomes really crucial.
Yeah, exactly.
Okay, so I think we've established, that corrections are totally normal. Panic selling is not a good idea, and there might actually be some deals to be found out there. But let's get to the really important stuff here. What is this expert's personal game plan for actually navigating this correction?
Yeah.
What are they doing?
Okay, so the source lays out a four-pronged strategy, and it all starts with staying liquid.
Okay.
And that doesn't just mean cash on hand. It also means having assets that you can easily convert to cash without losing a ton of money. So things like short-term bonds, that way you're ready to pounce when those opportunities pop up.
Okay, but I got to ask, isn't staying liquid during, a time of high inflation kind of risky?
Yep.
I mean, aren't you just losing purchasing power?
That's a valid concern. And the source definitely acknowledges that, it's a bit of a balancing act. They advocate for having a portion of your portfolio in liquid assets, not the whole thing.
Right.
The key is to have enough to capitalize on those sudden drops without being completely exposed to inflation erosion.
Okay, that makes sense. So what's the next step in this strategy?
So the next step is to really focus on company fundamentals. It's so easy to get caught up in, the stock price roller coaster. But
Hmm.
remember, that's just reflecting how the market is feeling at that moment, not necessarily the company's true value.
Right.
So you got to look at things like revenue growth, their
Hmm.
profit margins, their debt levels, to really assess their long-term health.
So basically, tune out all the noise and just look at the bigger picture.
Exactly.
Love it. Yeah. All right. What else does the source tell us to do?
So the third point is to buy gradually. Trying to time the market perfectly is basically impossible. So instead, you want to spread out your investments over time.
Okay.
This is what's known as dollar cost averaging, and it helps to mitigate the risk of buying at the absolute peak.
That's so smart. Okay. And the final point.
The final point, and this is a big one, is to maintain a long-term perspective. Market corrections are temporary, they always are, and historically the market has always recovered and it's gone on to climb higher.
Right.
So don't let these short-term fluctuations derail your long-term investment goals.
It's like that statistic we were talking about earlier. Missing a few good days can have a huge impact on your overall returns. So the
Yeah.
key is just to stay in the game even when it feels tough. Awesome. So if we had to sum it all up, what's the biggest takeaway from this deep dive today?
I'd say the biggest takeaway is that market corrections, while they can definitely be unnerving, they're a natural part of the investment cycle.
Right.
And by understanding the dynamics at play and adopting the strategic approach, investors can not only weather the storm, but they can potentially even use it to their advantage.
I love that that's a really empowering way to look at it. And before we wrap up, I want to leave our listeners with one final thought. This expert strategy is super insightful,
Mm.
but how does it apply to you specifically? What questions should you be asking yourself about your own portfolio in light of this correction?
That's a good one.
Remember, this isn't about, blindly following someone else's plan. This is about using this knowledge to make informed decisions that align with your own financial goals. So think about that.
Definitely food for thought.
Exactly. Thanks for joining us on this deep dive, and we'll catch you next time.
Yes.